if there is no money, there is no GP split. Preferred equity can be a third-party lender. It can be maybe an investor. It can be someone that has a big check, big money. It can be a family office. It can be anybody. I'm giving preferred returns to my limited partners. I have a preferred equity partner also on this deal that I'm supposed to give preferred returns. So let's go back to this diagram. Remember here, I have preferred equity. This preferred equity can be a third-party lender. It can be maybe an investor. It can be someone that has a big check, big money. It can be a family office. It can be anybody. And their interest rate is typically between 12 to 18%. So if I have this kind of people, based on how it is structured, I still owe them preferred returns. And let's say here I have my limited partners and myself or my GP members here. And I've also promised the limited partners that under the common equity preferred returns. And that means the limited partners that are here, I also owe them preferred returns as well as the third party investor that borrowed me money. So I'm owing two people preferred returns, but they all fall in different categories and all that. So going back to the complex capital stack I was talking about. So what I'm trying to say here is in this scenario, I have two people I'm giving preferred returns to. One is a preferred equity partner, the one that gave me, let's say, 3 million. And I have also my limited partners, which are the LPs that I just said I was going to give them 7% preferred returns to make this deal attractive. So the key feature of this is that both groups are compensated before common equity holders. So in this category, you have two people that are collecting the preferred returns. I'm going to compensate them before the GP on the common equity side. This returns is also fixed, just like I explained. For example, my limited partners gave me 3 million and my preferred equity partner gave me 2 million. And my limited partners, I'm holding it over 2 years. Over 2 years, I owe them 420. And my preferred equity partners, let's say they're giving me this a type, it's supposed to be 2 years, but let's just go with the example. So my preferred equity partner, I promised to give them over 3 years, 900,000. That is a percentage of the 2 million that they gave us throughout the 3-year-old. So my total preferred returns will be 420 for the limited partners and 900,000 for the preferred equity partners. And the combined of preferred returns is about 1.32 million. So remember when I started, I said that you need to be careful how you structure your deals so that you don't eat up all the cash flow from your deal and all that. So that is for the preferred equity side. Now I'm moving to the common equity. That's the last category which has the highest risk. The common equity is the GP-LP split in this category. So the GPs typically take between 20 to 30% of the profit. That is, the profit here now is the cash flow, whereas the LPs here take between 70 to 80% depending on what you're offering them. It means that the LP members go on with 80% of the profit and the GP members goes on with 20 to 30% of the profit. And this is after you've paid them their preferred returns. After you've paid the LP members their preferred returns, that is when you can go ahead and do a GP split. So if there is no money, there is no GP split. If you look at my screen, this is a sample of a GP split. So let me explain it briefly. We're going to do the practical of this next week using an example. So after I've paid my senior debt, I've paid my mezzanine, I've paid my preferred equity partners, and I've also given my limited partners their preferred equity. Let's assume I'm left with $500,000 at the end of the year. This is the GP split. I'm going to use this GP split to divide it among my GP members. So this split is actually for the GP, not for the LP. The LP will take 70% of the 500,000 that is left. The remaining amount from the 500, which is the 30%, now comes to the LP. You can structure your GP split in this way. So for a GP split, there are different categories. So it depends on you how you want to structure it. Some people have only 3 items under their GP split. Some people have 5. Some people have 6. But for me, this is the standard GP categories that I've decided to use, and I will explain them shortly. So in this category, you have sourcing, contract, and closing. In this category, whoever is sourcing the deal, that means the person that called the broker, got the deal, and put it under contract, will fall under this category. Whoever is discussing this thing with the lender, you're going through the closing process and all that, all of you are under this category. This category entails due diligence, contract closing, sourcing for your property manager, bringing in the team. This category falls under that. Please, if you have questions, maybe you can ask me, but I'll just take one if there's anyone now before I continue. So if you have one, just let me know. So the next category after sourcing, contract, and closing is the risk capital. Why do we put this as a category? Because it's actually risk capital. There's some funds, some money that you have to put down before you close. And let's say, for example, you did not close the deal, or you're not able to raise the equity, or you pulled out during the due diligence. You found out that some things were not right, and you decided to pull out of the deal. The money you spent ahead of time can never be retrieved. It's gone. So that's why it's called risk equity. So monies like EMD, monies like the money you pay to your lawyer to do the documents, maybe your transactional documents, that is your operating documents, the money that you use to pay your SCC. There's the money that you pay to the lender to conduct appraiser and environmental, and they call it goodwill money. That money goes ahead of time and is not refundable as well. All those monies are called risk capital, and you are not getting them back if anything goes wrong. So that is why some people give it a big amount of percentage. Then you have the balance sheet guarantor, people that are called the key principal, the ones that will use their net worth to sign as a guarantor on the deal. If you've watched my video, I explained what the net worth of a deal should look like. So if you're bringing a KP to help you become a guarantor on your deal, the KP must have a net worth that is equal to the loan amount. So if the loan amount is 7 million, the KP must have 7 million and above net worth, and also must show 5 to 10% cash liquid in his account. And if it's for a government, which is the Freddie or the Fannie, you must show some form of experience. But if it's the bank that is the lender, you don't need to show any experience, but they will want to drill down into who is managing the property. That is, the property manager now becomes very, very important if you're dealing with a bank. So that is for that. Then the next aspect is the asset manager. This is the only role that continues after every other role has ended once you close on your deal. These are deals, the sourcing, contract, and closing are before you close on a deal and when you close on a deal. The day you close on a deal, this role ends. The risk capital, the day you close on your deal, this role ends. Balance sheet guarantor, this is ongoing because the bank will keep reassessing, especially if you get the loan from the bank will keep reassessing the guarantors. But if your lender is Fannie or Freddie, they'll keep assessing the property and all that. So it depends on who you're getting your loan from. These people's role might not end at closing. So it just depends on whoever you're dealing with. The next one is the asset management. This is the only role that starts from the beginning and ends at the time you sell. Even after you sell, there's still some jobs you'll be doing after the sale of the property. So this role, I tend to put an emphasis on the percentage that goes in there. I try to reward it a lot more because it's a role that is ongoing, and without this role, this entire deal might not succeed. The next one is investor relations. So sometimes I categorize investors relations and capital raising as one. On my deals, I put them all together because if you're raising capital, you are actually creating a relationship with your investors, and the way to do it is through communication. So that means you'll be sending out information to them and all that. So you cannot leave one and do the other. They are intertwined. So I tend to add them together. It's only on very few cases when I'm trying to give people an opportunity, maybe for different reasons, like maybe they can't raise money and I see that I want to assist them in starting up a deal. I might bring them in here to just support for them to do their first deal. But really, I tend to put both together as one role. So this is like an idea of what a GP split is. So if you look up, you'll see this part, percentage of GP and deal ownership. Let's say the GP members made 500,000 as profit from their cash flow. This is a percentage that will be used to divide what each person will go on with. So for example, if we made 500,000 as cash flow, the 30% here that you're seeing here, that means the GP members made 500,000. Let's assume we made 500,000 and the LP made way more than that because they have 70%. So if we made 500,000, that means BB's share out of this 500,000 that we made is 23.3% times 500,000. That would be the cash I'll go on with. and Jack will go on with 17.7% of the 500. So this is how you get the money, your share of whatever you have as your cash flow or whatever it is. But this deal ownership is the amount of the equity that I own on that property. So it shows me that in this big property of, let's say, $10 million, let's say the deal is $10 million, that means BB owns 7% of that asset. So that means I own 7% of it, and Jack owns 5.3% of it. Joe owns 7.63% of it. You keep going like that. So this shows ownership, and this shows what this is used to share the money or tons or profit or whatever it is. This is what you used to share it. But for in terms of ownership, this is what you own on that property. I hope I was able to explain that very well, because I don't know if I did a good job. Was it clear enough, or you need me to go back to it?
There's feedback in the chat. They said it's clear.
Okay, it's clear, good. This is an example I created. So I have two examples. One is complex, the other one is not. So let me explain this with this example. So I have a property in Texas, it's 14 million. And for my underwriting, I realized that I want to hold this property for 3 years. That means in the third year, I want to refinance, or I want to sell in the third year. With my underwriting, I realized that if I'm able to perform or do well on this property, work on the NOI, this property in 3 years should be worth 22 million. Fine. So how do I raise the 14 million to buy this property? The lender has done their underwriting, and they said they're going to give me 65% of the 14 million. So that means they're going to give me 9.1 million at an interest rate of 5.5%. 9.1 million minus 14 million, that's still a lot of raise. That means I still have to raise over 5 million, maybe 6 million, including closing costs. And I've looked at my surroundings and my friends. I'm not sure I can raise it. I said, okay, I'll go look for mezzanine debt. I'm going to ask the senior debt if they are open with me doing a second position mortgage, that is getting another lender to give me a mezzanine debt. And they said, yes, go ahead. As long as it does not exceed this number, we are open to it. I go to meet my lender. I need a second position mezzanine. And they said, based on the underwriting, we can only give you 10%. I said, okay, fine, give it to me. I'll collect it. So that means I have 9.1 plus 1.4 million, but my mezzanine is at 8%. Gradually, I'm filling up the gap. And I did my calculation. My 9.1 is about 10.5 million. I'm still far off. I still have to raise maybe 5.5 million or 5 million. So I need more money. So I called on my preferred equity partner and I said, can you please give me more money? And they said, okay, yes, we'll give you 10%, 1.4 at 12%. I said, okay, no problem. And all that, and I accepted. Then for the common equity, at this point, I'm only left to raising 2.1 million. I decided to call my friends as GPs. We all came together. We put down our money. We also raised some from the limited partners. And this time around, there is no interest on this. This is just a 70-30 split. I raised this money and all that, and I'm able to raise the entire 14 million. So based on that, this is what this looks like. What would the sale of that property look like? Looking at this, that means I owe my preferred equity partners 1.9 million, including their initial investment. They gave me 1.4 million at 12% for the next 3 years. That means I owe them 1.4 plus 504, the total of almost $2 million. And my common equity is 2.1, 70-30 split. So going to the distribution side in terms of sale, let's assume I've done the property, we've worked on it, and everything came out well. I was able to sell this property for 22 million. So this is how the payoff will look like. I'll pay off my senior lenders 9.1 million. I'll pay my mezzanine lender 1.4 million. And I'll first of all pay my preferred equity partners their 1.4 million that I owe them, their principal, and I'll also pay them the preferred returns on it, which is about 504,000. I'll pay them off. Then after I've paid them off, I have a remainder of 9.5 million. It is now this 9.5 million I can now distribute with the LPs and GPs. So the LPs will now take 70% of this 9.5 million left, and we, the GPs, will take 30% of this 9.5 million left. Now, the problem with this is, what if you're not able to sell it for 22 million? Let's say you sold this deal for 18 million. Because the economy was bad, because the interest rate went up, my net operating income was very low. I was not able to sell it for what I projected it was going to be. That means I might be able to pay off everybody, but I will not be able to make any money to give my common equity partner. So that is why this is the highest risk in the entire thing.